Okay, I think we're going to go ahead and get things started here today with everybody. 5:02 o'clock. I want to welcome everybody to the AAMC First Webinar Series. My name is Jonathan Chancellor. I'm an Education Debt Management Specialist working in the Office of Student Financial Services. Today, we are very honored and pleased to welcome Mr. Michael Clancy. He's from the Drexel School of Medicine. What he's going to do today is talk to you about managing your finances as a resident. A lot of you would have already started your residency program back in June or July. But now, for some of you, especially those of you who are borrowers and those of you who are just getting into your residency, you're starting to really acclimate yourself to how to manage your finances, right? You're a few months in, you're looking at your budget, you're starting to get used to that salary or that stipend. So we wanted to bring in a pro here. And that is what Michael is. He's a pro when it comes to this topic. So, what we're going to do today, before I turn it over to Michael, let all of you know that we are recording the session. So it will be available for you at a later date. Once we get the recording, we'll let Michael look at it. And he's also going to provide this slide deck for us. So if anybody does want to copy the slide deck after this, we'll be happy to provide that as well. Once the recording's available, you'll get an email letting you know where it is, where you can find it, and that is there for you to watch. So that's going to be our process today. Now, I think Michael and I discussed earlier, when it comes to your questions, put them in the Q&A or the chat. Michael and I are both going to be looking through those. But Michael, if you have a preference, let him know here in a second. But go ahead and put your questions in there. He'll answer those throughout the session, but also we're going to make sure to leave some time at the end so that Michael can get to those as well. So I'm not going to take up any more time. This is Michael's show. So Michael, I'll turn it over to you. The floor is yours.
I appreciate that very much. Thank you, Jonathan. Welcome, everyone. For those of you that don't know me, I'm the Executive Director of Financial Planning at Drexel University's College of Medicine. I've been doing these types of talks, whether it's one-on-ones or in lectures or workshops, to probably at last count, well over 4,000 physicians. I teach core curriculum classes at multiple hospitals for house staff members. Um, if any of you are CIR members, union members, I've been giving the student loan talks for the past year and a half. I've known the union well and have consulted for them in the past. So I had a whole career prior to this in wealth management. I'm a certified financial planner and chartered life underwriter. Today's talk is not a deep dive on student loans. It's not a deep dive on investing or taxes or any specific topic. It's more about how you should think about your finances while you're in residency and keep that for beyond. Now, the assumptions, every time I walk into a room, I always assume everyone there is single. I'm going to assume you guys all are under a relatively tight budget. The residency fellowship years, the training years are not really a wealth accumulation period of your life. So I'm going to assume everyone here has a very tight budget. And I'm also going to assume you all have massive amounts of student loans. Now, if you are married, we're going to adjust the topic appropriately. If your budget is more robust, has plenty of room in it, great. You'll know exactly how to explore that. And if you don't have any student loans, that's fine as well. But these are the assumptions of the audience. The topics, we're going to talk about budgeting, about goals and setting goals and prioritizing the dollars, touch on employee benefits if you have questions there, going to introduce the topic of taxes, investing, what to do when you change jobs. I mean, if this is a prelim year for you and you're moving on to your categorical hospital, or you're finishing up residency, moving on to fellowship, or going into your attending years, you are going to be changing employers either soon or throughout your career, possibly. Touch on insurances. We can touch on, combining households as a married couple and how to view things. And of course, credit related issues. So a lot of topics in general, again, not deep on any one of them. Now, budgeting. I used to make my private wealth management clients do a budget. They hated it. It's not something fun by any means, but don't make it too complex. It is simply a estimate of what's coming in and what's going out. You all have had several months of paychecks now, so you really should have a good idea on what's getting directly deposited into your bank account every month. You've been living in this new town for a couple months now, so you should have a good idea of what your spend is in any given month. You should be done with all the one-time things, whether it's furniture or moving expenses and so forth. So stuff should be settling down right now, and you're into your routines as to when your grocery shopping days are, preparing meals, door dashing, or whatever. I'm going to assume you have more coming in than is going out, but not an excessive amount more. You're not necessarily paycheck to paycheck, but it probably feels like that. Now, why budget? Why did we go with the, most unglamorous topic at all? Is because when you have relatively tight finances, there's what you should do, there's what you want to do, but really it comes down to what can you do? And why I bring this up is I'm sure all of you have come across those white coat blogs, the different finance blogs out there, even pamphlets, little gifts and you know uh, charts as to you need to do this first, then this, then this, then this. None of that puts it into context. None of that puts it into your specific situation, what your goals are, what your financial abilities are, what your budget allows you to do. So you honestly have to ignore all those, white coat finance talks out there because they're talking very generically. And what I used to tell my students was ignore the attendings when they try to tell you financial advice. Half the time they are wrong. The other half the time they're right, but for their specific situation, not your specific situation. So any advice, guidance, literature that you read, etc., does have to be tailored towards your specific situation. So again, don't be distracted thinking there's things you must do or want to do or should do. It comes down to what can you do. Now, budgeting, again, keep it simple. It's literally what's coming in versus what's going out. Use a spreadsheet, use paper, download an app if you want to. This worksheet, that little screenshot that's a worksheet that the first team over at the AMC puts together. You could download that today, and I think if you do it online, it's interactive where you can type right into it. Think in terms of broad categories: housing related expenses, car related expenses, personal related expenses. You don't have to necessarily drill down on every subtopic, but you could if you want to. But for now, think in terms of broad categories. Um, if you're a credit card spender on things, you might not even have to break down the categories. You could just go month to month to month, looking at what your total credit card bill is for that month. If you're a debit card user, you could grab your bank statements over several months. And I always tell my students this: every bank statement has four numbers on it. Now, I'm sure you guys are all environmentally friendly and you're paperless, so you have to download your bank statements, but they always have four numbers: beginning balance, all additions, all withdrawals, ending balance. Simply grab the all withdrawal number for the month of July, for the month of August, for the month of September. That one number is your entire life. It was every auto pay, every, credit card bill, Uber, Venmo, rent, utilities, etc. It was all in that one number. If you want to track it that way at a very, very high level, great. At least you're doing it. The fact that you're doing a budget puts you well on the way to successful money management. Now, if we want to think about the categories or how they interact, there are what are known as fixed expenses and there's what are known as variable expenses. Your fixed expenses would be the same amount every single month, something like rent, or your monthly car payment, or your monthly auto insurance payment, or your parking charge. If you're on a cell phone plan or a data plan, etc., chances are it's the same amount every month. Variable expenses are the things that fluctuate. You might have had a lot of air conditioner use in the summer and you got a lot of oil heat use in the winter. The utilities are going to vary. Your personal expending, groceries, etc. It's going to fluctuate. Did you get a weekend off finally? Well, you're probably going crazy. Maybe you're flying away. That weekend, you're going to spend more. So variable expenses fluctuate. But then we also have to look ahead. Do you have any things that you're going to be spending money? Are you replacing that sofa? Are you traveling home for the holidays? Any significant one-time purchases? that are unusual, but you definitely need to accommodate. So you can kind of think of the expenses from a time standpoint, from a variability standpoint as well. Now, it doesn't have to be fancy or anything like that. Here's a rough outline of a budget for someone in, for example, the Philadelphia area. Let's say their PGY salary is 70,000, their take-home pay after taxes, etc. What expenses do they have? They could have rent, they could have groceries, transportation related, data plan, throw some money in there for entertainment or amusement, gifting if you're helping, siblings or something like that. Throw a student loan payment on there, put money aside towards emergencies, maybe even putting money aside towards investing. If you're already paying for disability insurance, throw that on there. Do you have any other subscriptions or auto pay that you've got, landing on your bank statement or credit card bill? You gotta need to track it. So again, it's what's going in, what's going out, what's left over. Yeah. So again, there's nothing fancy here. This is just an Excel spreadsheet. Now, you do need to have an emergency fund because things happen, and that's the nicest way I can say it. Um, those two pictures are my cars. The one on the top, a truck decided to be in my lane at the same time I was there. The one on the bottom, some car decided to pull into my lane at the same time I was there. Now, I have auto insurance, but I'm still out the deductible. So you do need to plan on emergencies. What I suggest is keep about 2 months of bills in your checking account, at all times. This way, you can set up auto pay for everything that you need to do. Rent, utilities, car payment, loans, credit cards. This way, whenever the bill is due, there's enough there to cover it. The rent gets paid on the first of the month, even if your paycheck is until the seventh of the month. So keep about 2 months of bills so that anything coming in or out, we know it's covered. I do suggest auto pay for the credit card, for the rent, etc. You do not want to be missing a bill and ruin your credit just because you've been working, 36-hour shifts and everything like that. Now, beyond the checking account, all your excess money, which you might not have at this point if you're a PGY1, could be in your bank savings account. You could park it in a high yield savings account or a money market fund and think of that as your emergency money. So this would be a very prudent way to get started. I'm assuming you came out of med school broke. We're starting from scratch. Build up your checking account to 2 months worth of bills. Anything beyond that, start stockpiling as emergency money. Now, if you are currently not in repayment on your federal student loans, whether you're still in the 6-month grace period or you PGY 2s and above, if you're in the SAVE administrative forbearance or something like that, well, you haven't been making payments, but you've got to make sure that your budget can handle your student loan payments when they start for you. The rest of you that are already on a repayment plan and have a monthly payment, great. You can put that right into your budget as is. But if you're currently not in repayment, you got to make sure you at least leave a spot in your budget for that. If you have private student loans and that monthly payment is too high to fit your budget, you should probably look to try to refinance that private loan and get it down to a lower monthly payment. If you're in your grace period still on your private loans and you don't know exactly what that monthly payment's going to be, do look on your accounts and your loan servicers and go back to the terms and conditions of those loans and track down what that number is going to be. You don't want to be surprised by anything. But again, if your budget is too tight because you have this large, let's say multiple $100s a month of private loan payments, look into those banks that offer the refinancing for residency and get it down to a lower payment. For those of you that do have private loans anyways, even if you can afford the payment, what's the interest rate on them? Consider refinancing those private loans to something cheaper and hopefully save money that way. So again, student loans, we do need to factor them into the budgets. Now, note on credit card debt. Hopefully you guys have credit cards. Hopefully you're using them and paying them off in full every single month. That is the best way to maintain good credit. If you have a balance on your credit card that you've been carrying over from month to month to month, even if you're still in that teaser 0% rate or something like that, this needs to be your number one financial priority, is to get out of credit card debt. Everything else can wait. Let me repeat that. If you are carrying a credit card balance from month one into month two into month three, and you're being charged higher interest rates, you need to focus on that. Now, you could look into doing what is referred to as a residency and relocation loan. These are private student loan, or not student loans, but they're private loans, personal loans that are available to fourth year med students and intern years only. So PGYs 2s, 3s, 4s don't have that tool at their disposal, but if you're PGY 1, you do. That would be a way to swap your credit card debt at a high interest rate to something more reasonable and with potential deferment options to help get you some breathing room in your budget. I know the AAMC has a nice resource page on residency relocation loans. I tried to put the website in there, but go back to the first resources to look the information up there. So again, if you have credit card debt, this needs to be your number one priority, to the point that I would tell you to not contribute to employer retirement plans until you've paid this off, to not contribute to Roth IRAs until you pay this off. So again, credit card debt should be your number one priority. Now, speaking of credit, I do recommend everybody every year look up your credit reports. Go to annualcreditreport.com. That is the free site where you can download your credit report from all three of the credit bureaus, no cost. Some of you probably have like Credit Karma or all those little wallet apps, etc. That's fine, but you really do need to familiarize yourself with your existing credit report to see what's on there. Your number one concern is mistakes and errors and fraud. So familiarize yourself with that. You're going to see things on there like public inquiries. You're not going to see that on Credit Karma, but there's going to be more information on your own credit report. While you're at it, I suggest that you freeze your credit. Basically, you go on to each one of the credit bureaus, Experian, Equifax, TransUnion, go onto their website, log in, and freeze your credit. This way, no one can open up a loan in your name because your credit's frozen. You can temporarily unfreeze it when you need to. So for example, if you're applying for a new apartment lease next year and they're going to pull your credit, you can temporarily unfreeze your credit. If you're applying for a mortgage, you can unfreeze your credit, so therefore the bank can pull your credit report officially, and then it refreezes. You're protecting your credit by doing that. It's very convenient. So I do suggest that for everybody. Other things, make sure you update your mailing address on everything, even your schools, both undergrad, grad school, etc. For those of you that just graduated, you might get a 1098-T tax form based on the tuition you paid in 2025. Where are they going to mail that? Make sure they have your correct address. Obviously, your banks, your credit cards, your auto insurance company, any auto lenders, your student loan servicers, any investment accounts you have, old retirement plans from old employers. As you move, every time you move, you need to go back and update your mailing address. You don't want to miss anything, especially a tax form or a past due notice. Old retirement plans, maybe you were working at one hospital and you're in fellowship now. That old retirement plan, if it's too small, they're going to roll it out to an IRA and they're going to be mailing stuff to your old address. So again, make sure you update this, old employers, etc. And of course, open and read all of your mail. I know you're tired. I know you get home late at night. I understand. I've worked with thousands of residents, but make it a habit to go through your mail. You don't want to miss anything. Now, goal setting. People always want to jump right to investments. What should I do? Where should I go? And all this sort of stuff. What are your goals? What are you trying to do? And this way you can prioritize your next steps. Think in terms of when you need this money. And then you allocate that excess part of your budget towards those specific goals. You would want to use the appropriate type of an account that typically has some sort of tax favorable features for specific goals. You would invest inside those accounts if the time frame is long term, because investment comes with volatility. If the goal is relatively near, like next year or something like that, you need to keep the money safe. No variation, no volatility. Stability is the thing. So again, think of your goals, prioritize them, allocate, and then potentially invest if it's long-term in nature. So here's some examples. Paying off a credit card balance. Maybe your goal is to be totally done with that in 6 months. Or maybe you're trying to buy a house next year. You're planning on renting for this year, but the plan is to buy next summer. Or you're looking ahead, trying to pay for a wedding in a couple years. Or you want to be debt-free on your student loans in 10 years. Or you're trying to put, a dependent through college 15 years from now. Or ultimately, maybe retiring in 30 years, or you're trying to adjust for future healthcare expenses or something like that. So when you're thinking about these goals, write them down and the time frame to when you want to accomplish that goal. So for example, if it is paying off a credit card, then that's where you know to focus the money. Keep paying, pay it off in that amount of time. If it is something that you're going to be spending a year from now, let's say to pay for a house or a wedding or something like that, that money needs to be safe and stable. So your bank accounts, your money market funds, high yield savings accounts, etc., perfectly suitable for that. Well, what's your student loan repayment strategy? You're working towards public service loan forgiveness, or you're trying to be debt free, go private practice, etc. Have a strategy and make sure you make progress towards that goal. If it is college for that little one of yours, maybe you can set up a college savings account. They're referred to as 529 accounts. That would be a perfect place for those dollars, but only if you can exclusively dedicate those dollars to that goal, not for any other goal. If it is retirement, this is where we get into the employer provided plans like the 403Bs, 401Ks, eventually the 457s, or possibly Roth IRA. Or is it future healthcare expenses? That would be a healthcare savings account, but only if you're eligible and only if that's the appropriate health insurance for you. Again, I read the Reddit finance pages for doctors. I read the white coat blogs and all that sort of stuff, and I chuckle sometimes, but they love HSAs, but they don't talk about whether it's appropriate for your health insurance needs, which is the primary driver of that account. So again, whatever you read, whatever information you get, you have to put it into context for your specific situation. Now, I mentioned types of accounts. What am I talking about? Well, accounts are what you set up to put your money in. Things like a bank account, could be a trust account, could be a 529 college savings plan, could be a retirement account, etc. They come in two broad categories. They're either taxable or they're tax deferred. If they're taxable, it means any activity in that account, interest, dividends, capital gains, will show up on your tax return that year. If they're tax deferred, all that same activity does not get reflected on your tax return that year. It's deferred. Now, what are we really talking about? An individual account in your name, a joint account with your spouse, a custodial account for a minor, trust accounts, those are all taxable. The tax deferred types of accounts are the 401ks, 403Bs that you find at work, the IRAs, whether they're traditional rollovers, Roths, SEP IRAs, etc., college savings plans, healthcare savings accounts, etc. Those are all versions of tax deferred accounts. There's a tax favorable feature to them versus the taxable accounts. Now, I mentioned the retirement accounts. They also come in two flavors. There's the more traditional 401ks, 403Bs, IRAs, and then there's the Roth versions. There is a Roth IRA. There is a Roth 401k. So it's one account. It's an IRA, but it's either a traditional IRA or it's a Roth. There's one 403B account, but you can contribute either via the traditional method or the Roth method. So when people say Roth, you're probably thinking Roth IRA, but it could be a Roth 403B at the hospital. The traditional versions, you get a tax deduction the year the money goes in. It's deferred as long as it stays there. It is taxed upon withdrawal 30 years from now. The Roth version, no tax deduction going in. It is deferred the entire time the account stays open, but there would be tax-free or no tax upon withdrawal. So they're mirror images of each other. You either get the deduction up front and pay tax later, or you don't get the deduction up front and it's tax-free later. Now, the 401ks, through work, 403bs, you have the ability to borrow from it. That's a feature I hope you never use, but it's there in case you need to use it. There are yearly limits on how much you as an employee can get into that employer plan. 23,500 is this year's limit for your age group. That's why I put it in red, because that number will slowly rise over time. For IRAs, the limit is up to $7,000 for someone your age. Again, it's in red because that number could change over time. There are penalties if you take the money out before age 59 and a half. So early on, when I said pick a goal, prioritize, allocate, use one of these accounts for their tax favorable features, but only if you can dedicate it to that goal. So if you need to put money into a retirement plan, but then need to take it back out prematurely, you're going to be taxed and penalized. So again, you have to commit yourself to this goal from a budget standpoint. Can you do that? There are required minimum distributions for those of you over age 73, where you have to actually start taking withdrawals and have to start paying tax on those accounts. So again, that's the topic for a couple of decades from now. The Roth version, the Roth IRA, believe it or not, you can withdraw your contribution at any time. So that's a nice little relief mechanism there. Again, the 401ks, the most you could do would be 23.5. The Roth IRA, the most you could do would be 7,000. No required distribution. All right, that's a nice feature. There would be penalties if you withdrew the growth early. So again, this is money for retirement. Roth IRA has a nice little feature that I'm going to talk about in a minute. So you're at work, your hospital offers you a 403B plan. You guys are in your lower tax brackets now. As attendings, you're going to jump up to a higher tax bracket. So while you're in your lower tax brackets, if you are contributing to your retirement plan at work, consider doing Roth 403B contributions, not the pre-tax. You'd rather pay tax during residency and get the money tax-free in retirement. So at work, when you've indicated you want to put a couple percent, 4%, 10% of your paycheck into your 403B plan, see if you can do it Roth version. When you're in a higher tax bracket as an attending, that's when you want to do pre-tax contributions, because it's going to save you on taxes, because it lowers the adjusted gross income number on your tax return, which for those of you with federal loans could end up lowering your income-driven repayment plan. So you're getting two benefits for that one decision. You will then pay tax on those dollars when you make withdrawals in your retirement years, but you're at your peak tax brackets while you're working, and then it comes down slightly in retirement. So you get a better benefit that way. Now, I kept talking about tax brackets. If you don't learn anything tonight, here's something hopefully you learn. Your income is taxed. The dollars are taxed depending on what bracket they fall into. So let's say you're PGY1, you're only working half a year this year. Maybe you're earning 34,000 or 40,000 at most, or something like that. Well, the first 11,925 is going to be taxed at 10 cents on the dollar. The remaining was going to be taxed at 12 cents on the dollar. As your income rises, those dollars at the margin, the last dollar you earn, is going to be taxed at that next bracket. So during the residency years, when your income is in that 10, 12, maybe 22% at most, let's say we're going to do a chief year or something like that, consider Roth IRA contributions and Roth 401, 403B contributions at work. When you jump up to your attending income, so take a moment, think about your specialty, think about that future compensation that you hear about. Where does that put you on this page? If you're going to be in those higher income brackets, that's when you want to do the pre-tax contributions because it will lower your taxes. And those of you with federal student loan payments could lower that payment as well. Again, we've got decisions that you're going to make now, but you need to understand when to change those decisions as you go throughout your career. This tax bracket chart is for someone single. Married couples, there's a similar chart with almost double the ranges. Up at the top end, it doesn't double. But again, you could look up the married filing taxes joint tax brackets. For those of you filing taxes separately, married filing separate, it's going to follow very closely to this scenario. Now, I mentioned Roth IRAs, tax-free withdrawals during retirement. That's wonderful. But you can also always remove your contributions anytime between today and retirement. So you want to contribute to a Roth IRA if your budget allows, and if that's a priority of yours, while you're still eligible to do it. We're going to talk about when you're not eligible. Convert retirement assets into the Roth IRA. So if you're sitting there with a traditional IRA or an old 401k from a prior employer, you might want to consider converting that while you're now in your low income tax years, because you're going to report it on your tax return that year versus dealing with it when you're in your higher tax brackets. Now, here's what I meant by you can withdraw your contributions. So imagine you put $1,000 into a Roth IRA, or even better, $7,000 into a Roth IRA. That is contribution, which you have already paid tax on. Hopefully that account grows. Maybe it's worth $8,000, $10,000, etc. At any time, you can always call up the IRA custodian and withdraw the money that you put in. It has already been taxed before. It does not get taxed again. Because you're under age 59 and a half, people would say, oh, there's a penalty. No, if there's no tax, there is no penalty. So maybe if you're sitting on some cash and you're thinking that's your emergency fund, why don't you park it in a Roth IRA? If you have an emergency, you can always pull the money back out. Now, you don't want to take fluctuations. You don't want volatility. So keep it very safe inside the Roth IRA so that way you don't lose money. If you have an emergency, fine. Withdraw what you put in. But if you don't have an emergency, that money is in a much better place for the next 30 years. If you do take out more than you put in at your age, yes, those dollars would be subject to tax and they would be subject to an early withdrawal penalty. But what you put in, you have 100% access to, no questions asked. Now, when I've given investment talks, I would say, I always start off by saying, here's a step-by-step guide. It's kind of like a cheat sheet. I'm kind of giving people the conclusions up front. Identify an investment goal. Retirement, marriage, kids, whatever. Budget so that you know you have the ability to set money aside towards that investment goal and that goal only. Open and fund an investment account that has some sort of tax favorable feature for that goal. Invest within that account based on the time frames of when you're going to take the withdrawals. Is it soon or is it further down the road? And your own risk tolerance. If you're scared of investments, if you want to be more conservative with how you invest, fine. If you're okay with risk, okay with volatility, okay with the potential to aggressively grow, fine. But you do need to monitor that account. It's not, not really a set it and forget it type of a person, but you do want to rebalance and based on those time horizons, et cetera. Because if that 10-year goal and you're now within a year of that goal, you don't want to be as aggressive as you were in year one when you're in year 9. So again, it is something that you do need to monitor. Now, what did I mean by the investment accounts? If it's in a taxable investment account, it can be used for any reason. You can withdraw your money at any time, subject to any capital gains or things like that. Whereas those retirement accounts, you really can't pull from your retirement account to spend on a wedding or to put a kid through college. And you're not going to use the college fund to pay for your retirement. So again, you do want to identify the goal, and then chances are there's an investment account that would be appropriate for that goal. Now, if you can commit dollars to that goal only, then you pick that account. So for example, when everyone talks about the wonderful healthcare savings accounts, remember, those are for future healthcare needs, not to put someone through college, not to live on during retirement or to buy a vacation home or something like that. So while it has some wonderful tax savings features, you only benefit from them when you're using it for this specific goal. IRAs, 401ks, et cetera, are for retirement. The college fund is for college, not for anything else. So again, you need to identify a goal, allocate towards that goal, and if you can exclusively dedicate the dollars to that goal only, then you pick the appropriate account for that. Now, Roth IRA. You can only contribute to a Roth IRA when you are eligible. Now, if your income is above the eligibility, or you're filing your taxes married separately, you need to do what is known as the backdoor method. And this traps a lot of physicians because you're thinking, I'm single, I'm in residency, I'm eligible, I'm going to make Roth contributions. And then lo and behold, you get married that year. And then for your student loan strategy, you decide to file taxes married separately. But you already made your IRA contributions. You actually have to undo those contributions. So as long as you know you're going to be eligible the whole year and you're going to file your taxes and still be eligible, then go ahead and make the Roth contribution. But if there's a little question as to how you're going to file taxes or what your income might be, especially if you're in your last year of residency and then you start your attending job, maybe with a sign-on bonus, you could easily be over the limit. Now, how to do a backdoor Roth? Step one, make a contribution to a traditional IRA. Again, it's the same cash, you're just putting it in a traditional IRA first. Step two, convert it to a Roth IRA. So it simply takes 2 steps to get the money where you wanted it to be anyways. It was already taxed before you even put it into the traditional IRA, so therefore it's not getting taxed upon conversion. Now, that traditional IRA should be the only retirement account IRA with pre-tax money to make this a very smooth transition. I'm going to show you why. When you're leaving an employer and you have an old retirement plan, most financial advisors are going to tell you to roll it over to an IRA. I'm going to point out that you really don't want to do that because it will mess up this backdoor process. So again, why the backdoor Roth? If you are single and your income is under 150,000, which is generally your residency years, you're eligible to do a normal Roth contribution. But what year is your income going to be over that range? It could very easily be the year you're finishing residency and starting an attending salary. Or maybe you're doing a chief year with a lot of moonlighting or something like that. Or, and you can see what the married filing joint threshold is. So again, if you're married and you're filing taxes joint, you have to consider your spouse's income as well. If you're going to file taxes married separately, then you can't do the Roth contribution directly because you're already over the $10,000 threshold. So if your income's too high or you're filing separate, plan on doing the backdoor Roth. So again, think about what year are you getting married? What years will your income exceed these limits? So as an attending physician, you're going to be doing the backdoor Roth the rest of your career anyways. Now, here's how it works visually. Step one, contribute to a traditional IRA. You're not going to take the tax deduction, so therefore the money is still after tax money. Step two, convert to a Roth IRA. You can use the same investment company, very easy to do, whether it's Charles Schwab, Vanguard, Fidelity, any of those types of companies. Now, what if you have an old retirement plan and some advisor tells you to roll it over to an IRA, or you're moonlighting somewhere and your accountant tells you to set up a SEP IRA? Very easy, simple, cheap to do. but yet you still want to do this backdoor method every year. Even though the money is coming from the non-deductible traditional IRA and going to the Roth, and you already paid tax on that, the IRS looks at all of your pre-tax IRA dollars to determine how much of the conversion gets taxed. So that rollover IRA that is sitting out there, or that SEP IRA that your accountant set up sitting out there, actually impedes you from doing the backdoor Roth in a tax-free manner. I'm telling you this now. I don't expect you to remember all this, but I see a lot of physicians get tripped up on this all the time. Now, you're saying, well, wait a second, what should I do with that old retirement plan? So all of you, as you change jobs, you go from employer A to employer B to employer C, and you have an old retirement plan, what should you do with it? Now that you're an ex-employee, you have 5 options. Option 1, you can leave it where it is. If there's enough dollars in that account, they will let it sit there. If it is too small, they will kick it out. Option 2, laterally move it to your next employer. So you're going from hospital A to hospital B. You're going to be setting up your retirement plan at hospital B. Transfer the old retirement plan into the new retirement plan. Option 3, this is what most advisors would tell you, except for me, would be to roll it over to a traditional IRA. Option 4, convert it to a Roth IRA. Now that's valid, but where are you in your career? You might have gone from low income up to high income at your new job. You don't want to be paying taxes at that time, and that's what the conversion, you'd be paying taxes. So if your income is still low, definitely consider conversions. Option 5, I have to list it. It is an option. You can always withdraw the money and spend it, but that's the worst option. Tax and penalty because you're too young. Now, I have done that for people that have had a lot of credit card debt. Again, if they have credit card debt, that's the overriding priority. Yes, we've cracked open the retirement accounts and gotten them out of credit card debt. But these are the 5 options that apply to everybody that changes jobs. My recommendation would be laterally move the money from the old employer to the next employer. That way, it's not blocking you from doing the backdoor Roth. Now, are you married? Well, your loan repayment strategy could impact your tax filing strategy, which could impact what you're doing with your Roths. A direct contribution, or do we have to do the backdoor? So again, if you're filing taxes separate, you need to do the backdoor. For those of you getting married, have a sit down, talk to your fiance, spouse, significant other, or partner. What are their financial goals? Communicate yours to them, listen to them when they're communicating to you, come up with your priorities, and therefore it might be much smoother allocating your budget. If you are married, now it's pulls in life insurance, estate planning considerations, and things like that. So people don't think of life insurance as a financial decision, but it really is. You're going to coordinate health insurance. You're going to notice hospitals are cheap. So maybe you want to go on their health insurance or they want to go on yours, but you can't add them because they have coverage through their employer, et cetera. But you're going through that open enrollment period every year. And that's what married couples do is they look at the employee benefits and prioritize, who should be on what. If you have kids, you're probably prioritizing who's got the better pediatrician network. Does your employer match your retirement plan? Well, maybe your spouse's employer matches and yours doesn't. So therefore, maybe you prioritize contributing to the spouse retirement plan to maximize the amount of those matching dollars, even if it means you're skipping contributing towards your retirement plan. So again, who's got the employer benefits, who's got the matching dollars, et cetera? You want to take advantage of that. And I did mention employee benefits. This is where you have access to things like those 403Bs, 401Ks, eventually 457s, your flexible spending accounts, your healthcare savings accounts. These are all set up through your employer. Right now in residency, you're getting a group life insurance benefit. There's group disability insurance. That's fine for now. That's not fine as an attending. You're going to want your own life insurance. You're going to want your own disability insurance. For those of you that have pre-existing health conditions, you need to jump on some of these decisions sooner than letting it go to your attending. If you're a homeowner, maybe up the group life insurance just so you have something and then work on getting your own personal life insurance policy. Even the non-physicians, the partners, spouses, etc., also need to have life insurance, etc. So there are other types of benefits offered through your employer. Hospitals are very large employers. They've got thousands of employees, so they tend to offer a lot of employee benefits, stuff you probably never bothered to read. If you think about your employee benefit brochure, it always starts health, dental, vision, prescription plan. So you're working your way down the page. Maybe it talks about flexible spending accounts, dependent care accounts, retirement accounts, etc., the group benefits, etc. But way down under those other categories is a bunch of other little things that you probably didn't get to. Legal services, they might offer that. So if you think you might need an attorney, whether it's to negotiate a home purchase or facilitate the purchase of a home, maybe to do wills if you guys have kids, things like that. Before you run out and hire an attorney, see if you can get some sort of discounted legal services offered through work. Obviously, for those of you with pets, look at the pet insurance and things like that. So there are always unique benefits offered. If it fits your needs, give it a consideration. I did mention the insurances. The health insurance you get through your employer. You're going to, review your options through the open enrollment period. For those of you on a January to January cycle with your employer, your open enrollment would probably be next month. For those of you on a July 1, it's not going to be till next spring. So all those benefits you picked when you first started working, well, now you're an existing employee, so you get to repick it every year. I mentioned the disability insurance. Right now, you're covered under a group policy through your employer. When you sign up for it, opt to pay your portion of the disability. Now, your employer's probably giving you some, and then you elect to pay for more. But if you're paying for it through your employer, opt after tax. The temptation is to pay for it pre-tax and lower your taxes. What are you saving? You're saving 10 cents on the dollar. By paying for your employer-provided group policy on an after-tax fashion, should you ever go on benefit on claim, hopefully you never do, but if you ever do, you would actually receive the benefit tax-free. If you're currently paying for your disability insurance on a pre-tax, when you go on claim, you would actually have to pay tax on your benefit, if you can believe it or not. For those of you with pre-existing health conditions, you should inquire if there is a guaranteed standard issue policy as an offer based on what hospital you're at. It's not necessarily offered through your, HR benefits. It's offered through insurance companies. They grant it as a privilege for people under certain hospitals. So especially if you have a pre-existing health condition and you're talking to an agent about buying your own policy, you want to investigate a GSI, guaranteed standard issue, first before you fill out any medical forms. Because if you get declined on a medically underwritten policy, you would never be able to get the guaranteed issue policy. So again, look at the GSI first, then consider a medically underwritten. Life insurance, it's offered through a group policy at work, whether it's a flat 50,000 or typically a multiple, 1 times your salary, 2 times your salary, 3 times, etc. That's fine for now. But again, if you've got kids, if you're taking on a mortgage, etc., then you really should look at a real personal life insurance policy that you own, that you take with you when you change jobs. These group benefits, you change employers, you're losing this coverage. If you're going to, let's say, a small private practice, they might not even offer this. And you're now older. Your health is now declined. You don't want to be stuck. So before you come out of residency, you all should look at your own individual policy for disability insurance. And when the need comes, look into your own life insurance policy as well. Again, this talk wasn't to dive too deep, but just touch on the topics. Now, I did get this question when I was asked to give this presentation. It's like, oh, well, what if you wanted to hire someone? I've been in the financial services industry, and I like to triage people to the right, service models. Why are we hiring them? What do you want them to do for you? Is it to help you with budget management? Is it investment management? Is it estate planning, tax planning, insurances? It could be business planning for those of you who go in private practice. Do we have to deal with estate issues? Did you inherit or win the lottery, have sudden wealth? I mean, there could be different things that you want them to address. That'll help you focus on who should you hire. Is it a legal matter? You go with an attorney. If it's a tax matter, you go with an accountant. If it's an insurance matter, you go with insurance. So again, you've got to kind of triage yourself based on what you want them to do for you. How do you pick one? What licenses do they have? What training, what experiences, what service do they offer? Is it, kind of ad hoc? Is it self-directed? Is it, fee for service? Is it concierge? You know, what are the fees? Who pays the fees? How are they charged? Is it recurring? Is it a retainer? Is it hourly? What are the conflicts of interest? They're not going to bring that up. You have to bring that up. If you're looking for advisors, NAPFA, National Association of Personal Financial Advisors, they are only fee only. So they are not commission-based advisors. You can go on their website and find a local advisor. The Financial Planning Association also has a planner search where you can go on there, put in your zip code, and bingo, there's local advisors. You want to grill them and so forth. Now, even if you got recommendations from a friend or something like that, you can also look them up. If they come under FINRA, you can do broker check. If they're a registered investment advisor, that would be under the Securities and Exchange Commission. There's advisor info on the SEC's website. So this is how you look up. And again, in my past, I had a stockbroker license. I am a registered investment advisor. Again, there's probably a record out there on, a file on me at FINRA. There's probably a file on me at the SEC. It's clean, of course. But again, if someone was going to hire me, this is how you check on the person's background. Now, again, very high level, touched on a bunch of different stuff.